Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy Management. The subject of this video is simple in a way, is why everybody's been wrong in predicting the recession. And if you go back to more than a month ago, I had another video, and I was talking about the problems with linear thinking. The issue is that when we start thinking about an idea, we have an opinion. It's very difficult to change that opinion. We go straight, and that's the way it's going to be, and it is. The fact is that business doesn't go on a linear direction. It turns. There's ups and downs, and that's what is called the business cycle. And depending on the ups and downs of business, you have different investment strategies. Then people get confused. How come I think there is a recession and there is a depression, and instead, commodities are going up, and we get all confused. So the objective of this presentation, a month ago I talked about the linear thinking. Now this presentation is about recognizing a turning point and convince yourself that there is a turning point, and now you got to predict the next turning point again. So let me put things in perspective for you with the next slides. The economy doesn't go on a straight line. There is periods of very slow growth, then starts improving. Here there is where the excesses, inflation, interest rates rise. This is when demand slows down. This is when interest rates and inflation they are weak and decline. Eventually things get normal, and then business starts all over again. So it's very crucial. I wrote several articles, I have several videos. You got to know where you are here, because depending where you are, there is a very specific investment strategy. Usually this is where there are the growth oriented, this is where there are the defensive sectors, and this is really ultra defensive. So let's see what the recent data are saying and where we are on this cycle, and then we know what to expect and what kind of investment strategy, what kind of investments we should make. This is an indicator that we compute in real time from market data that tell us what the business cycle is. This since 2009. Okay, there have been periods of strong growth and weaker growth. And so you have all these waves, and as you can see, there is not a straight line. Business grows fast and then slows down. The reason I had more than a month ago the problem with linear thinking is because you saw this curve and it said we are heading for a recession or depression or whatever. But the thing is that a turning point happened. And this is where it's very difficult. Still people forecast recessions because they did not recognize, or at least they don't want to accept, that there has been a turning point. We don't know how long it's going to last, but the fact is that the business cycle last fall has turned up. And so we have to adapt. Now let's see why, and then how we can use this curve to develop an investment strategy. Let's see now why everybody was bearish for the last 6, 7, 8 months. Why? Because of the yield curve. The yield curve is the difference between the 2-year and the 10-year yields on treasuries. And when the yield curve gets negative, like here, that is, the 2-year treasury yields are higher than the 10-year, and they become negative, and here 0 to negative, and here very, very negative, unusually negative, that means a disaster in the economy. There's always been deep recession here every time there has been a recession. So it was very easy, and it's still very easy to forecast a recession, and probably very deep because of the unusual inversion of the yield curve. And this is what for the last year or so, this is what everybody was saying. And the big famous names, not only they predicted or were predicting a recession, but also deflation. Why? Because if you look at the real money supply M2, that is money supply adjusted for inflation, is contracting like never before. So this contraction in liquidity has to have, people were saying, a very deep impact on the economy, not only in terms of growth or contraction, but also in pricing, deflation. And by the way, I was saying the same thing because I was linear thinking. But this is eventually is going to come, but you don't know why and you don't know when. I'm sorry, not why, when. And that's the purpose of this presentation, to give you a timing framework. Last but not least, for the extreme bearishness, is because the red line shows the yield curve. What I showed you before is very inverted, it's negative, with the 2-year way above the 10-year. But the blue line shows the percentage of banks increasing lending standards. I have inverted the curve so you can see the relationship with the yield curve. And as you can see, this is in a survey done by the Federal Reserve. And they are increasing lending standard. They are increasing spreads between the cost of fund and the lending interest rates. And why? Because banks are seeing risk. So not only you have the inverted yield curve, which is predicting further increases in credit risk. So yes, we're going to have a recession, call it depression, calling the deflation. This is what the monetary data are saying, and this is what everybody was talking and is still talking about. Now, having said that, let's see now how the economy is responding to all this very extremely bearish financial monetary trends. And this is the last piece of information that really guarantees that we are going to have a recession. And this is this trend of interest rates. And this is from 1950s. Every time you see rising interest rates, rising interest rates, rising interest rates, rising interest rates, you see a recession. You see a recession. However, just to give you a leg up, you have a recession after interest rates declining, but still, they are still going up. So now let's see how the economy is responding to all this. I hope you don't mind if I brag a little bit, but the point of this slide is to tell you, I'm saying what I'm saying, not because I recognizing now what's going on, but I've been suspicious that that was happening already months and months ago. And this is one of my subscribers, a comment to one of my tweets and videos. And he says, I remember you were one of the first person I had to say that fiscal expenditures may be the driving force of this market rally. So the point that I'm trying to make is there's been a monetary tightening. However, the industrial policies of the government have been so strong. The trillions of dollars spent in chips and in plants and green energy and in infrastructures and trillions of dollars been so overwhelming that we cannot, the people have ignored that phase, that part of the business cycle. And this is, if you want to have an investment strategy, you have to recognize the effects and the momentum of these efforts. Let me show you what I mean. This is the graph of durable goods orders. And by the way, all the data that I'm going to show you, they are after inflation, so they're adjusted for inflation. Look at this trend. It's really amazing. This is a big ticket items that cost a lot of money, and in order to finance them, you have to in order to buy them, you have to finance them. So the fact that interest rates are high, business doesn't care little or nothing, because look at this trend. Growth is unbelievable. It's around 5+%. Very, very strong. This is an amazing chart. Again, it's all after inflation. I just could not believe it when I saw it. People talk about consumers as strapped and this and that, but income look, this is income and spending after inflation. This is growing at 2-3%. People are making money, income is increasing, spending is increasing. There's no way there is going to be a recession with trends in income and spending at the increasing. They're not even slowing down. They're still accelerating. They're still strengthening. And it's not, there are other things. Just a second, I'll show it to you. This graph shows average hourly earnings after inflation. Notice how it shows the business cycle, okay, rising, declining, rising again, and then declining. This is an accelerating business cycle. This is an amazing curve. This average hourly earnings are increasing at more than 4%, and they're accelerating. People are making more and more money after inflation. You cannot have a recession with this kind of trends. You have a recession when you have this kind of things. So we are still going up. We are still accelerating. It's really unbelievable what is happening. That's why the indicator I showed at the beginning that we monitor has been turning up, because it's sensing that there is strong economy, stronger economy, despite all what the Fed, quote unquote, is saying and trying to do. I follow closely, very closely, the sales of heavy trucks. Why? Look how pretty this chart corresponds to the first chart that I showed you that I compute using market data. It's unbelievable, exactly the same turning points. Investment strategy in this direction has to be completely different from here. Stronger economy, weaker economy, stronger economy, weaker economy. Look at what happens to truck sales. They are growing at an amazing, amazing rate. And so there is heavy business is shipping stuff. And I know that rates are cutting, rates are what, but how come there is so much demand for heavy trucks? That means that the economy is strengthening, certainly not weakening like during this time or this time. It will happen, but not right now. And what happens to the 6, 7, 8 trillions, who counts them anymore, that the administration has spent with their industrial policy? It went to construction. And this is what happens to construction. Goes straight up, went down a little bit last year, but now it's picking up again. It's very strong. You have a recession or a slowdown when construction starts declining. But momentum is very, very strong. Housing is strong. Housing is strong. So these are not numbers or trends that you see here or here. These are trends of the economy that is improving. I wouldn't say booming, but it definitely is getting momentum, especially with the income and spending. Those numbers are really, really impressive. The Federal Reserve Bank of Atlanta has an exceptional model, has been right on the money the second quarter and every quarter. And they, as soon as there is a piece of economic information, they put it in their model and they tell us how fast the economy is growing. Right now, the economy is growing at 4.1%, when all the consensus of the forecaster, they say the economy is going down, it's going to recession, there is a depression, there is this and that. But the fact is, in Q3, the economy is really, this number means the economy is booming. I don't want to say that because I would be embarrassed, but this is it. This is it. As an investor, you got to keep that in mind. And if you don't believe it, you better believe it. But if the economy is strengthening, yes, the money comes from the government and the industrial policy of the government giving money to the various sectors, chips, infrastructure, green energy. But somewhere there has to be a measure of money that is flowing through the system. And digging in the data, I found that there is this measure of liquidity. Actually, there are two that are similar. They bottomed in last October, last fall, and they started growing. And sure enough, as this thing improved, also the economy improved as well. And above all, the markets start going up. So this is a trend that justifies that really, yes, the economy, better believe it, has been and is improving. Until when? Let's see. This is the crucial thing. And this is hopefully I'm going to give you some input. And the markets have been responding to a stronger economy as you would expect they would. Commodities are very sensitive to changes in economic growth. And since last fall, the CRB, which is a commodity index, started going up, confirming, yes, the economy is stronger. And the direction of commodities is also confirmed by rising short-term interest rates. Yes, I do believe that interest rates are set by the markets. In fact, these rates started going up a good year and a half before the Fed started tightening. So this trend is up. Why? Because commodities is going up. Why are they going up? Because the economy is strengthening. How did the markets respond from October 2022 to the improving economic condition, improving liquidity, and improving economy? Well, that's exactly what you would expect in a stronger economy. In a stronger rising business cycle, you have technology, communication services, industrials, discretionary, and materials outperforming everything else, which are the defensive sector. So what you see, what we have experienced so far, is that growth sectors, the ones that perform well during the up leg of the business cycle, have been outperforming. So the market has confirmed, yes, George, what you have seen, that the economy is strengthening, you're right. We agree with you. This is the chart that I showed you at the beginning. Stronger economy, weaker economy. Here, in this phase, when the business cycle rises, you have to be aggressive with cyclical stocks. When the slowdown comes with the economy in all these periods, here and here, you have to use defensive sectors and possibly cash. What the markets are saying is that from fall of 2022, the cyclical growth stocks have outperformed the defensive ones. So yes, don't think linearly. Now the turning point has happened. This trend is over. Forget about depression, recession, what people heard. The fact is the economy has turned around. There has to be a change in the mindset. Until when? Okay, this is the purpose of the next chart. What are the data telling us? Forget about opinions. The data are telling us that the monetary trends are in this phase. Why? Because this is when you have declining growth in the money supply, you have inverted yield curve, you have increasing percentage of lending standards by the major banks. That's typical of this phase because the financial system is trying to bring things under control, things that went out of control before. But because, and this is a new thing in this cycle that took me a while to understand it, but again, more than a month ago, something was bothering me. But what happened in this cycle, though, that the trillions and trillions of dollars passed by Congress are overwhelming the actions of the Fed, the restrictive actions of the Fed. So what you see is rising inflation, rising interest rates, a strong economy, which is typical of the latter phase of phase two. Now, this is important. It's phase two. What does it mean? That yes, it's fine to be on growth stocks. However, at some point, like in every business cycle, there is a slowdown in demand. Once the slowdown in demand is here, then you're going to start the corrective phase of what has been happening in phase two, which is rising interest rates, rising commodities, and possibly inflation is not going to go down as much people have expected so far. Maybe after this turning point, after the economy goes full-fledged back into phase 4, maybe then is what is going to happen. But right now, what is happening is that we are here. And what it means is that growth stocks, commodities, and interest rates are going to be the trends higher. That's what is going to happen. So the fact is that interest rates, if I am correct that that's where we are, they're still going to rise. You have to check carefully the commodity part, the CRB. If crude oil and the CRB go up, then you know that we are here and we are getting closer and closer to a renewed slowdown. So this is the way I see it. So we are still a strong economy. There is no recession in sight because, as the Federal Reserve Bank of Atlanta is reporting, really the economy is booming right now. As you know, I'm the editor of the Peter Dack Portfolio Strategy and Management. You can get a free subscription by going to this website. McGraw-Hill Education asked me to write this book, and it's been printed in English and in many languages, especially in Asia. I wrote 2 other books, and you will find all my articles in the website and also on video. Thank you very much for following this video. I hope I gave you some ideas, and you can find more information about me on this website, on YouTube. I have several other videos. I'm very active on Twitter, not so much on LinkedIn. Anyway, okay, thank you very much for following me. Please do subscribe, and I hope to see you really, really soon. Take care of yourself. Bye-bye.